Hello buddies, this is CMO Altaf. So here I am with another video which will be discussing about the amendments that has happened in the income tax for the CA or CMA May 2023 or June 2023 upcoming exams. And this video is intended for both inter and final bodies. So what I will be discussing is I will be discussing the amendments which is applicable for both inter and final at first instance. Then after that I will be discussing the amendments which is applicable for the final bodies exclusively later. Okay, yes, so keep watching. Yeah, so let's start with the amendments. Okay, I'll be discussing only the amendments, and that also amendments which is either it is came new for these exclusive for this attempt, or latest amendments also I'll be discussing that might have come before this attempt, but I think it's relevant that those things also will be discussing. Ready? Yes, and further I'll be discussing only those amendments which I personally consider is very important for exams, because some amendments, some clarification, I think that is not at all applicable for in the sense not all important for exams, so those things I'll be ignoring. Okay, yeah, so let's start with the discussion. So I'll be discussing first thing which is applicable for both inter and final level. Okay, yes, let's start. So I'm just following my personal books, and most of you might be having this book. If anybody not having, don't worry, whatever books you are following, you just make changes wherever necessary. Okay, yes. And the first thing I want to just clarify that, because so many people are asking this doubt every time, whenever there is a budget, there is a doubt. So we have a recent budget, that is 2023 February, right? We have a budget in February 2023. So many of you might have aware that there had huge amendments regarding the tax rate, like they have changed the slab rate and all, and many other things have been newly brought in. But the thing is, I already made a video on this on my Instagram that is saying that because of I was getting so much of messages asking whether this is applicable for this coming June or May 2023 exams. But you have to understand one thing: a budget of a 1 year will be applicable from the next year's exams onwards. That means Feb 2023 budget, that is a budget you have seen latestly what they have released, that will be applicable from which exams onwards is May or June 2024 exams. That means that is not even applicable for the next November or December 2023, right? That will be applicable from May or June 2024 exams. So what budget are you studying? You are studying budget 2022. So budget 2022 is applicable for this 2023 exams. That is a basic understanding all of you have to have. Okay, yes. So in the slab rate we don't have much changes, so I'm just showing wherever amendments have done. So no amendments in the rate of the slab rate. Okay, yes, okay. So we don't have any amendments in that first chapter, second chapter, status. Okay, so I'm not just wasting my time. So what I'll do is that I'll be directly picking those areas where amendment has happened. Okay. Yes, there is a small amendment in section 35, that is in PGBP we have in scientific research. So we don't have any amendments in salary, HP and all. Okay, so don't worry, whatever you studied for the previous attempt you can just continue those things. Okay, except in that is what we say new perquisite something called, right? So there there is small changes, but that is not important. Okay. So anyway, in the scientific research also, not that important, I have not given here because it's sorry, I have given here, but this actually not that what we say askable in the exams, right? See, what is the amendment is these associations. So you might have studied the scientific research, so where you might have studied 100% of the deductions, and if you were contributed to scientific research, etc. for to these institutions, right? But there is a section called 35(1)(f), which says that these associations, okay, they have a duty to submit a statement, okay, submit a statement regarding this donation received. Okay, these entity, that means the institution where you are contributed to. So those institution, they have a duty to submit to the income tax authority a statement regarding the donation received. So if these entity, you have, for example, you have contributed a 1 lakh to this national laboratory for scientific research. So, but this national laboratory or that university or that IIT which is not complied with that requirement to submit that statement, what will happen is that you will not get the deduction. So for that default, you are the person going to suffer, because you will not get the deduction under section 35 for that contribution. We're getting? So that's a small amendment I've made here. Okay, so no deduction of these entity not complied with the section 35(1). So if you don't have this what is the wordings in your textbook, please copy this. Okay, but that is not that important. Okay, anyway, fine. That's one amendment that you have to look into in section 35. That's in PGBP. Another amendment they have brought in is in residuary expenses. That's actually not necessary amendments, or what we can call it as a redundant amendment. Okay, I'll tell you why. Section 37, all of you might be knowing, this is also under PGBP. 37 is a residuary expenses. That means if any expenditure which could not be taken under section 30 to 36, then those things you can take under this section 35 if it is related to business, right? Okay. Then what is the amendment? It's not an amendment, it's actually explanation they've inserted to this section 37, which says that we all know these what we say, if anything which is prohibited, okay, offenses or prohibited by law is actually what we say disallowed. That means you cannot take those items. Example, business entity which is given a quotation what we say against their opponent, the competitor. So those amount you cannot claim as a business expenditure because it's prohibited under law. Okay, so they made more clarity on this. Okay, the expression expenditure incurred by necessity for any purpose which is an offense which is prohibited by law would include and would be deemed to have always included. That's the retrospective effect. Okay, what is expenditure incurred by necessity for any purpose which is an offense under any law for the time being in force in India or outside India, or which is prohibited by law for the time being in force in India or outside India. That's one thing they have inserted. Then to provide any benefit or perquisite in whatever form to a person, whether on carrying on a business or exercising profession, and acceptance of such benefit perquisite by such person is in violation of any law or rules or regulation or guidance as the case may be, and to compound an offense under any law for the time being in force. That means they have widened the scope of that prohibited by law. Earlier there was a little confusion because those things which is only prohibited by law is disallowed. Okay, so what about the to compound an offense, something like that? Okay, so they have made it clear that now everything which is disallowed regarding that. So they have given an example also. That's what I told this what is a redundant provision, because it's already disallowed. For example, these doctors, okay, they will be getting a freebies, in the sense kind of a commission from the pharmaceutical industries for promoting their brand, the medicine brand, right? So this is actually against that medical what we say ethics, medical regulations, against the medical regulation. So it's actually held in previous court law. In the court law they have already held that those things are prohibited, so you cannot claim that expenditure. So here also now, since they widened the provision of section 37, those case law is not required. So you can directly quote the section 37 to disallow those freebies given to the doctors, because it's actually it will be coming in any of these things, right? So they simply, what is the amendment? They have widened the scope of this what we say prohibited by law. So earlier we have only this prohibited by law. Now it's they've widened that, saying that it is either prohibited in India or outside India, whatever things. Okay, so everything will be disallowed. So those legal things only you can take it as expenditure in the PGBP, right? That's one amendment they have brought in. Another amendment they have brought in this section 40A. Section 40A, which talks about the disallowances regarding the non-deduction of taxes, etc., right? So there we had something called disallowances for other payments like income tax, and cess, etc. on profit. That means income tax is disallowed. So what is the amendment they have brought in? it's not an amendment, it's a clarification. So as if we don't know, they're saying that tax includes surcharge and cess. Already, even before that amendments, we only know that tax includes surcharge and cess. So they have again clarifying that tax includes surcharge and cess. So you have to disallow the entire amount. Say for example, your tax is 10 lakhs and surcharge is 3 lakhs and cess is for what 10,000 for example. So everything shall be disallowed. You cannot take any of these things to PGBP expenditure. Okay, so everything shall be disallowed, not just tax. You have to disallow surcharge and cess. Everything you have to disallow. That's another amendment they brought in. Another small amendment they brought in is in section 43B. So deduction only on actual payment. We all have studied that certain payments will be allowed only if you have made the payment within the 139 due date, right? And there is an explanation we had saying that the payment does not include what we say you converted the interest into loan, right? Converted interest to loan. So what is the amendment? They have already they have added that convert into debentures or other instruments. That is amendment. So earlier we have explanation saying that if you have, for example, you have a pending interest of 10 lakhs, so you converted this interest to loan. So this will not be what we say. This cannot be regarded as a payment. Okay, this 10,000 we cannot 10 lakh we cannot regard as a payment. So we had already this amendment clarification saying that this conversion into loan is not a payment. Now they included that conversion to debentures or other instrument, whatever, that also not regarded as a payment. Okay, simple. Okay, that's a small amendment they brought in. So that's all about the amendments that is in PGBP. So only few things in section 35. They're saying that those associations, if they are not filed the statement, the person who contributed to those associations will not be eligible deduction under section 35. And under section 37, they inserted a clarifications that is prohibition means prohibition in India or outside India, and it is to compound an offense. Everything will be disallowed, right? So next one is as I told you, the last one, right? Okay, that conversion to debentures or conversion to other instruments also not regarded as a payment for the purpose of section 43B. That's all. Small amendments. In the capital gain also we don't have much amendments. Only things you have to understand is that we have CII, cost inflation index, for this 2020-23 is 331. That's the one thing you have to understand. And there is another thing you have to actually, if you want, you can go through, but I have not given it in the textbook. That is okay, not here. There is a computation they have given for this section 10 subsection 10D. That means LIC maturity. A total messy computation I've actually not given in the textbook because I don't think that is relevant for these exams, right? Okay, if you want, you can just go through the ICA material regarding this section 1020 computation. Okay, yes, that's all. Nothing else in the capital gain chapter. We have no other amendments. But there is one thing I just want to show you. One thing. Let me show you that. In case of the surcharge computation. Earlier actually we have surcharge rate is 10%, is 10, 15, 25, 37 different rate was there, right? But now they and they were saying that in case of 111A, that means short term gap beginning on which STT paid, and 112A, long term gap beginning on which STT paid, and dividend. On these three things the surcharge rate should not exceed 15%. Now they added this 112 also. Okay, now they added 112 also. That's one thing you have to understand. And I'm not going to the computation. I've given so many computations here, but I'm not going to do that now because that's not our purpose, right? Discussing the amendments all. Okay, now under IFOs we have a small amendment in that 56-210, that gift case, right? So in the gift 56-210, what is amendment is that in case non-applicability of that 56-210, where we might have studied from relatives like relatives and all, it is not what we say taxable, right? But then now they have inserted a new entry to that non-applicability of that what we say 56-210. That means not taxable if any amount received by a family member of a deceased person from employer of the deceased person, then without any limit fully exempted. From other persons, for example, any of your family member deceased due to COVID-19, and so you received some compensation, not in the sense like some what we say helping hand, like some amount from different persons, so that is exemption up to 10 lakhs. But there are some condition and they have given in a wider way, but I've made it very short. So there are some conditions. The amount shall be received within 12 months from the death of the person. Okay, and also death of the individual shall be within 6 months from the date of testing the positive for COVID. Otherwise, we can say that it may be due to other illness, right? So they're saying that that person might have what we say dead or deceased within the 6 months from the date on which is diagnosed with COVID, right? And the family members shall keep the medical records. All these conditions are there. So if these conditions are satisfied, if you receive any amount from the employer of the deceased person, so without any limit, fully exempted. But then if you receive from another person other than the employer, then it is exempted up to 10 lakhs. That's another amendments. Okay. And then in case of deduction from gross total income, there is no much amendments, and but there is a as I told you, there is a what we say 10-10D computation is there. That's a messy computation. So if anybody wants to refer that computation, you can refer the ICA material, but because I'm not going to waste my time on that, because it's a huge computation there, but I don't think they will be asking for 8 marks or 10 marks from that a single topic. I don't think so. So it's actually, I think it will be waste of time for that 10-10D computation. That's why I'm not including the material. So if anybody want, you can just go through that ICA material. That's a supplementary material they've released. Okay, so it is there in the supplementary material. So I'm not going to discuss that. And there is another amendment in 80CCD, that means in NPS. Okay, what is amendment is that we might have studied 80CCD2, that's the employer contribution. For that also the employee will be getting a deduction, because I'm not going to discuss what is 80CCD2 first, because that is not my intention. I'm just showing the amendments, right? So what is amendment is that earlier for central government employee we have 14% deduction, other employees 10%. Now that means state government employees also was actually coming under these other categories, but now they included the state government employees also here, so they also will be getting that 14% deductions, right? Okay, another amendment in section 80DD, which talks about the what we say a person who is actually maintaining another person with a disability. For example, Mr. A is maintaining Mr. B. Mr. B is suffering some disability, right? So here we have a small amendment. See, maintaining a person would include his medical treatment or some other treatment like that. Also, it includes you taken an insurance on that person with disability. Okay, so Mr. A is taken an insurance for the benefit of that Mr. B. So what is amendment is that so here you can read it. That maintaining would include paid or deposited to insurance for maintenance under the scheme framed in this behalf by LIC or any other insurer. But this scheme shall provide for the payment of annuity. Annuity means yearly a payment or monthly payment or lump sum amount for the benefit of the dependent being disabled. Here a small mistake is there. In the event of, you can just go there, in the event of death of the individual in whose name subscription was made. Okay, in the event of death of individual in whose name subscription was made. This point was there in the before amendment also. But what is amendment? Here, on attaining the age of 60 years or more by such individual, and the payment or deposit to such scheme has been discontinued. See, what they're saying is Mr. A and Mr. B. Mr. B is a person with a disability, right? So Mr. A has taken an insurance for the benefit of Mr. B. So this insurance scheme shall provide for the payment to Mr. B on what event? On the death of Mr. A. That was the earlier what we say earlier provision. Death of Mr. A. If Mr. A dies, then the insurance company shall pay the amount to Mr. B. That the scheme shall provide like that. Or now they're saying that, or death one that is still there, or this A attaining the age of 60 and the contribution to this insurance scheme has been stopped. Like, so that also discontinued. So in that event also the insurance companies shall start paying to the Mr. B. Shall start paying the Mr. B. That is a that's how the scheme shall provide for. Okay, so that is a new amendment. So this is the, so I'll tell you once again. Mr. A taken an insurance for the benefit of Mr. B is a disabled person, right? So those things also will be eligible under 80DD as a they will be deemed as a maintaining Mr. B. But then that scheme shall provide for what? That insurance scheme shall provide for paying the amount to Mr. B in the event of death of Mr. A. That's one condition. Or when the Mr. A attaining the age of 60 and Mr. A discontinued the payment to insurance policy. Okay, so those in that event the insurance company shall pay the amount to the Mr. B. Okay, so those scheme also eligible under 80DD deduction. Okay, that's amendment. That's all the major amendment in 80DD, and this is a small thing they have inserted. That's not that important. The next one is, and in TDS and TCS we don't have amendments. I hope all of you might have already studied this 194O, 194P, 194Q, 194R. Okay, 194R actually that's there is a clarification they have given. Let's see, but that is let's see. Okay, that's a huge clarification they are given regarding this what we say 194R. So it's better you guys read the IC material, because I don't think they will be asking much about that what we say 194R. So there is a clarification they have inserted for inter and final. So 194R, all of you might be knowing that TDS on perquisites or benefits in connection with the business or profession, right? So, and there is a one thing you have to understand, that this benefit or perquisite does not include discount, okay, sales discount, etc. That also there in the clarification. So I've read the clarification, but I don't think they can make a question from that clarification. So that's why I've not included those things in here. Yes, okay. So and TDS you have to aware about this 194Q, 194R, 194P, like there are a lot of other sections they have brought in. Okay, not for this attempt but last attempt. So I hope all of you might have gone through that. Okay, and then another thing is that in case of TCS, okay, TCS, what is amendment? Let's see. See, I'm just discussing the amendments which is exclusively came for this attempt. Okay, otherwise we have many other amendments that is came forward the last attempt. I hope all of you have already studied that. Okay, then what is the amendment? Let's see. A small amendment that is on 206C 1G. Okay, 1G in the sense like we have this one, right? On these foreign remittance, they have to collect these taxes, right? So what is amendment they brought in is that when the buyer is a NRI and who does not have a permanent establishment in India, then also this 206C or 206C1G that is not applicable to payment to an NRI, in the sense like buyer is an NRI and who does not have a permanent establishment in India. Okay, that is the another amendment they have given in the TDS and TCS. Okay, so other than this, for the inter bodies, I don't see any kind of amendments in inter level because I told you right. This new budget is not applicable for your exams. Your exams is based on the budget 2022. Okay, so yeah, and in that no much amendments, and I hope all of you have studied these other TCS provisions. Okay, 194Q, 194R, 194P, 194N, all those things have brought in the last budget. So that is only new things they have brought in. I hope all of you have studied that. Other than that, nothing else for the inter bodies. Okay, but for final bodies, we have many other amendments in different other chapters that we'll be discussing in the coming discussion in this video itself. Okay, yes. So I'm just confirming for my inter bodies. Don't worry, you have a few amendments that to catch up. That's in the salary. I've given a small amendment, and then the PGBP salary. That's not a big amendment. In PGBP, a small amendment, 35. I've already discussed, right? And one or two amendments we have discussed in capital gain and IFOs and what we said deductions, and only these amendments you have to catch up extra. Okay, thinking that all of you have already discussed the other sections. Okay, so this is only new things are brought in. Okay, only new things are brought in. So if you have studied for the last attempt, you can continue with those theory, and you can go confidently to exam hall. Don't worry. Okay, yes. So for my final students, you have to catch it up. Other amendments also. So for my final students buddies, you have a small amendment in set off and carry forward of losses. So where it I'll show you. The amendment is in section 79, which talks about the carry forward of losses of a closely held company. That you can simply understand like a private company. That means any losses of a particular year can be carried forward and set off to another year only if the shareholders of that company is say for example you have incurred your loss in 2018-19. So that loss, if you want to carry forward to 2022-23 and to set off, the shareholder is holding at least 51% share in that 2018-19. That means a year in which you incur the loss shall continue to be the shareholder in 2020-23. That's a condition. Okay. And in case of some eligible startup, that not just 51%, it is all the shareholders shall continue. That's also there is a condition, right? So, but then there is a non-applicability. These things is not that 51% or that all shareholders. Those conditions is not applicable if it's unobserved depreciation, transfer on account of death, etc. That's all already were there. But now they included one additional exception, saying that this transfer this is not applicable to an erstwhile public sector company. That means a company which was a public sector company in earlier previous year and ceases to be a public sector company by way of strategic disinvestment, meaning a sale of shareholders by central government. So in that public sector company, central government or state government had shares and they have disinvested. That means they sold those shares due to their strategic disinvestment. And in that situation, the shareholders come down below the 51%. In those situations, it's okay. You can still carry forward the losses. Okay, if these shareholders came down below the 51% because of the strategic disinvestment of these central government or state government. So balance you can just read. So this is the amendment they have brought in. Okay, so that you have to understand. Then in case of assessment of various entity, assessment of companies, we have, right? So what is amendment we can see there? There is a small amendment like 2020-21 you have to make it. Okay, 2020-21 does not exceed 400 crores. So I have actually given earlier the correct one. Now I forgotten to change here. Okay, and then okay, another amendment is this 115BAA and 115BAB. I'm not going to explain what it is actually, but then what is amendment is that there is a condition for claiming this concession rate, and it should be commenced manufacturing on or before 31/3/2024. That is amendment. So this is extended now to 31/3/2024. Another important amendment in 115BBD. That's a huge amendment. We had something called dividend taxation in case of specified foreign company. That means a foreign company in which you have more than 26% of voting power, right? So it will be taxable at 15% and all, no expenditure can be claimed. But this is not applicable from the assessment date 2023-24 onwards. So it is now taxable at normal rate. So even if you getting a dividend from a specified foreign company, the rate of tax is the same, exactly same, which is applicable for other companies, other assessees. Okay, so there is no special rate for this dividend now. Yes, that is a huge amendment. Then there is a new taxation they have been brought in, that is taxation of virtual digital assets. That means like Bitcoin and all, right? So that is a new amendment. So what it is means, what it is, what we say, virtual digital asset. Like, what is the definition they have given? It means any information or a code or a number or token not being Indian currency or foreign currency generated through cryptographic means or otherwise, but whatever name called. So you can just copy it. This is the meaning they have given. So I'm not going to explain it detail, but I'll tell you the taxation. So there are something which is specifically excluded from those virtual digital asset definition. Gift cards, vouchers being recorded that may be used to obtain goods or services or discount on goods or services. That means gift cards. Okay, coupons, that is not a virtual digital asset. Okay, so mileage points and subscription to website or platform or application, those things are not virtual digital assets, so that's not coming under the purview of this section. Okay, taxability, tax rate is 30%, no deduction. Okay, no deduction, no expenses can be claimed like commissions, whatever you cannot claim. Only thing you can reduce is that the cost of acquisition. No set off of loss is not possible against those income, and the loss of that income cannot be set off with other income. No set off is possible in either way. Then the next one is VDA need not be a capital asset. Okay, to tax this VDA, it may not be a capital asset, it can be anything. Okay, yes. So VDA received as a gift. So in the capital asset definition 56.210, it includes this VDA also, virtual digital assets. So it is so even if it's received as a gift, still taxable. But if it's not taxable, if it is received from a relative, that we have discussed under 56.210, right? Okay. Then TDS under 194S also coming for this VDS at 1%. Yes, that's a new taxation. And non-applicability of TDS. TDS is not applicable if the specified person, that means an individual HUF whose accounts were not subject to tax audit in the last year and the payment is not more than 50,000. In case of other person, the provision is not more than 10,000. So the TDS applicability, if you are an individual or HUF and your books of accounts is not subject to tax audit in the last year, then the limit is 50,000. In other cases, it is actually 10,000. Okay. Then there is a detailed clarification that issued on VDA. I have not included those things. Okay. So have a basic understanding on VDA. That's it. Okay. And in case of charitable or religious trust, we have a amendment. Amendment in the sense, in case of procedural things, they have brought in so many amendments. Let's see. One amendment I'll tell you, this is a forfeiture of exemption. The charitable trust, their exemption will be forfeited if they have used their income for some, some other purpose, right? So, income applied for the benefit of interested person like trustee or some other person, right? I've given here who is an interested person or the trustee, contributory. So, if you have used the income of the charitable trust for the benefit of these persons, then the tax rate will be 30% under 115 BBI, and the penalty under 271 AAA also will be levied. Penalty will be 100% of such amount for the first time. If you continue doing, then 200% of such amount. That is the penalty that you will have to pay. And there is a consequence of violation of provision, certain violation. What is a violation? Since like you all of us know that you all of know that if it is having some trade or business or commerce, then the receipt from those things should not be exceed 20%, or it fail to maintain books of accounts, etc. So the in these cases the computation of the income of the trust shall be done in the following way. They can reduce the revenue expenditure, but the following conditions shall be satisfied for the reduced revenue expenditure. So these actually more or less similar to our PGBP computation, like we have to disallow this capital expenditure, all those things. So that means if they actually violated this provision, they will have to pay the taxes on the income, and the income shall be computed in this manner. That's a simple thing. So, and then 115 BBI. 115 BBI also a newly brought in section. The specified income is when you are not spend at least 85%. That means you have accumulated more than 15% of that what is the total donation, or deemed income in case of that we already discussed. And okay, so in these cases, in these specified income, the taxation will be 30%. Okay, in these violation, you can reduce expenditure on everything, but in this 115 BBI, you cannot reduce any expenditure. Directly 30%. But here you can reduce everything. Only disallowances you have to see. That's it. Okay. Yes. Then 12 AB. There's a new section they brought in. So there's a major change in under the registration procedures. So we have I've given the summary here. Okay, it's actually not a new change they brought in. It's actually were there from 2021 onwards. So if anybody not aware of this amendment, you have to go through this. Okay, so I'm just seeing here. You can take a screenshot of it, because it's a new, not a new amendment. That's what I'm not going to what we say discuss. Yes. Yeah, fine. That's it. Okay, so that's a charitable trust. Charitable trust, the procedure they have totally changed, and I've given a summary here. And then this 115 BBI that you have to go through, and this also section 10, 13, 10 and 11 that also you have to go through. Okay, yes. Then let's see what is another amendments they have brought in. In cooperative society, this is not a new amendment, but then you have to aware of this section 115 BAD. The tax rate will be 22 plus, surcharge 10% plus S. This is more or like 115 BAC. That's for individuals, right? So you cannot reduce these deductions, although more or less similar to that 115 BAC. So you have to just go through this rate 22% plus, surcharge 10% plus S. This is applicable for the what we say cooperative society. Okay, yes, that's it. Then in case of return of income, we have a few amendments. I think all of you might be aware of these things, right? So these people also have to submit the return of income, like deposited 1 crore in current account, or the expenditure more than 2 lakhs in a foreign trip, and the electricity expenditure of more than 1 lakh, or the person carrying his business and his total sales is more than 60 lakhs, and person profession having more than 10 lakhs, a resident individual whose age more than 60 years at any time, and the aggregate TDS TCS is more than 50,000, and any person aggregate TDS and TCS is 25,000. Means if it is a what we say senior citizen, then their TDS TCS, if it is more than 50,000, they have to furnish a return. If it's other than senior citizen, then if the TDS TCS more than 25,000, then also they have to submit the return. Okay, then SB account, saving bank account, if they are deposited more than 50 lakh, I think all of you might have aware of this. Then what is the amendment is that there is something called modified return. Okay, where is that modified return? Yes, modified return. That's a one thing they have brought in, modified return. Modified return in the sense like if any business reorganization take place as per any court order or IBC. Okay. So in those situations, the successor company shall file the modified return with respect to that year. So I given an example here. Say for example, A Limited merges with B Limited. So B Limited is the successor company. With effect from 1/4/2021, they are merged. Wide order of the High Court dated 1/11/2022. Okay. And the B Limited already submitted the return for the assessment year 2020-23 on 30th October 2022. Now then B Limited shall file the modified return on 2020-23 in accordance with order. So already A Limited has filed the return, but since the reorganization has been done, B Limited shall file the return for the same year again. That's a modified return. So ITR A is the form in which they have to submit the modified return, right? Okay, fine. So and another there is something called updated return. Okay, that also not a new thing. All of you might be knowing this updated return. Updated return in the sense like you can revise the return rate, or you can file belatedly a return, but there is a time limit to that. Is it must be within 9 months. Okay, 3 months before the ending the assessment, right? So after that, so for example, the time limit for that belated return is already done. So can you file the return again? Yes, that is an updated return. So updated return, what we say, there is some scenarios where updated return cannot be filed, that you can just go through. In case of updated return, you have to pay the tax of, if you have updated return can be filed maximum for 24 months. Okay, I've given somewhere else 24 months, that is the time limit. But then the taxation is actually different. If you have filed the return before the 12 months from the end of the assessment year, then you can you have to pay 25% of additional tax. Okay, you have to pay additional tax you have to pay 25%, but after 12 months, but before 24 months, then you have to pay 50% of the additional tax in the sense of the tax and the interest, okay, fine. So that is the updated return things, okay. So updated return, you have to go through that, okay. In case of assessment procedures, we have small amendments, okay. Let's see. Before that, let me give you a simple idea on the assessment procedure. First of all, SSC can be, they might have filed the ITR, they might not be filed the ITR. So if you have filed the ITR, that means income tax return, system will assess the first. Computer will be the first person to do the assessment under 143(1). So they will be sending an intimation. So after that system assessment, this all return will be assessed by system. After that, it will go to scrutiny. That maybe some items will be might have done scrutiny. For that, they will be issuing the notice under 143(2). And certain assessment are already done, but then the department thinking that okay, some income has escaped, then they can do the assessment under 147. For that, they will be issuing notice under 148. So under these sections, they will be issuing notices if they are not replied, okay. If they have replied, then they can complete the assessment as per this section under complaint 153. But if they are not filed the ITR, or if they are not given the reply to these notices, then the other option the department has is 140 for best judgment, okay. So I'm not going in detail as a regular classes, okay. I'll be discussing only the amendments, okay. So for having an idea, I've given a small summary here, okay. Now in 143(1), you might have aware of this because this is not a latest amendment. 143(1) intimation shall be sent within a period of 9 months from the end of the financial year in which return is filed, okay. So 9 months, that you have to understand. Now another amendment in 143(3), that is scrutiny assessment. They have to serve the notices within 3 months from the end of the financial year in which a return is filed, okay. Yes. And there is a small amendment they have given 143(3). So in case of charitable trust, or specified institution under section 1023C, see, in that situation, assessing officer cannot issue an order directly. They cannot issue a scrutiny order, okay. Say for example, assessing officer is actually planning to withdraw the exemption for the charitable trust. So first of all, they have to intimate the central government. Then the central government shall withdraw the exemption. Then the assessing officer shall pass an order accordingly. That was there earlier also. But what now they have inserted is that in case of section 11, or that means a charitable trust or any institution under 23C, they made any specified violation. For this definition, you have to refer the charitable trust. In charitable trust chapter, we have discussed this specified violation. If the charitable trust done the specified violation, then also the assessing officer shall follow this procedure. Then only they can withdraw the exemption. Okay, so they have to refer the cases to PC or C. Here they have to refer the case to central government, right? Here they have to refer to principal commissioner or commissioner. Then they have to withdraw the exemption. Then only assessing officer can pass the order. So this is the one new thing they have brought in: specified violation by the charitable trust. Okay, fine. And in case of income escaping assessment, that is under section 147. We have actually some amendments they brought in. Let's see what is that amendments. Okay. So one amendment they have actually brought in is that there is a section called 148A. See, income escaping assessment in the sense like of any income which has escaped the assessment, like 143, whatever assessment they have done. But then assessing officer later think that okay, that income has escaped the assessment. That means the income was not subject to the assessment. So they can reopen the case. So actually 147 reopening the cases. So earlier for 147 they used to issue the notice under section 148 directly. But now they have inserted 148A. They have to do an inquiry. Before the notice. They have to do an inquiry. Okay. So then give a opportunity of being heard. Okay. Then okay. So all these things they have to do before they issuing the notice under 148. Okay, so this is a new thing they have brought in. Okay, they have to comply with the 148A, some inquiry, right? Okay, that is the new things they have brought in. Next one is non-applicability of 148A. So the 148A is not required where the search is conducted like that. Okay, so any search or requisition under 132A. So in this situation 148A not to comply. So what is the amendment? They have to comply with the 148A, then only they can issue notice under 148. But in this situation, the compliances with 148 is not required. Okay, yes. Then the time limit for I already discussed that for 147 income escaping assessment, they have to issue notice under 148. Okay, they have to issue notice under 148. Before that 148, they have to conduct inquiry under 148A. Yes, okay. So we are talking about this 148 notice. So when the department can issue notice, when they have an information, information in their hand. Okay, when there are informations, certain information based on the information flagged in any assessment year in accordance with risk management strategy or any audit objection to the effect that the assessment in case of assessment not made as per the act. This is also an amendment because earlier an audit objection under CAG was the only thing they were given. Now any audit objection can be given. So based on this, the assessing officer might be having an information, or in certain cases assessing officer deemed to have some information, in case of search is conducted or requisition under 130 is made, or survey is made under 133A. So if the assessing officer done the search, done the requisition under 132A, or done the survey under 133A, in that situation assessing officer will be deemed to have information that the income has escaped. Okay, so and then they can issue notice for how many years? If the income escaped is more than 50 lakhs, then for the 10 years. Other cases they can issue notice up to 3 years. This is the maximum time up to which they can issue notices. Another important amendment that's actually latest recently they have brought in is, earlier search, you have to remember this. Okay, so if you've listened to classes 1 year before and all, or you might be making mistake. See, we have a search under 132 and we have 147 income escaping assessment. Earlier assessing officer will do the search first, then after search any unaccounted money something have revealed, then they have to issue notice under 153A, and also they have to complete the assessment under 153A. Now this section has been removed. That means if any search is conducted and any income is actually been found, now they have to complete the assessment under 147. So they have to issue notice under 148, not 153A. Now 153 has been removed, so that you can see here. That's why in case of income escaping assessment we have this 132 search is coming. Okay, because any income, any money, any something else you found in search shall be assessed as per this section 147. Okay, so that's been merged. 132 and 147 has been merged now. So 153A has been removed. Yes, that you have to understand. Yeah. Then I've given so many examples there that you can just go through and all this. Next one. Then the time limit 153. So whatever assessment like 143.3 or 144 or 147, it has to be completed within a specified time. So what is the amendment is that in case of 144 or 143, it has to be completed if it is relating to assessment 21-22 onwards, it has to be completed within 9 months from the end of the assessment year in which income is first assessable. And okay, then in case of what is the next amendment is that's it. Okay, about that's a 9 months. Okay, in case of this 143, 144, if it's done for the assessment year from one assessment 21-22 onwards, then it has to be completed within 9 months. Okay, That's one amendment they given 153. And then next amendment, let's see. Now in case of appeal, we have one small amendment, that is in appeal even in case no order is passed. See, normally you will be going for an appeal regarding or against an order, okay. But we had a section called the section 248, where, say for example, what will happen is that you are a resident in India and you are making payment to NRI. So normally when the resident is paying to NRI, the resident will be deducting the tax from the NRI, then balance amount will be paying. But in some situation, what will happen is that between the contract of this resident and NRI, this resident will have to pay the tax out of his own pocket. Instead of deducting the tax from NRI, this resident will be paying the tax directly out of his pocket. So he has paid, for example, 1 lakh rupees, but then later he understood that this NRI's income was not taxable in India. That means this TDS was not required, so this 1 lakh is not required to pay. So how can this 1 lakh get it back? How this resident can get this back? Through the appeal. Earlier he had to submit an appeal before CIT appeal. Now it has been done away. Now they are saying that this resident can instead of going directly to appeal, what he can do is that he can file an application for refund. There is a new thing they brought in, application for refund in prescribed form. So if that application is rejected by the proper office, then only he can go through go to CIT appeal. Are you getting, everyone? Yes. Okay. So that is amendment. Earlier we could have this resident directly go to appeal, but now he can directly apply for refund, and if any issue with the refund application, then he can go to appeal. Okay, that's an amendment. Another amendment is we have a 158A provision for avoiding repeated appeal, because like for example, you already have a cases pending with the High Court or Supreme Court, and the exactly same issue again arising. So the assessing officer is going to pass the order in the same way, but the previous case already pending in the High Court or Supreme Court. So the assessing officer will wait till the order is passed by the High Court, right? So that is 158A, and we had a 158A also. 158A also. Now the department has actually removed that 158A. Now instead they have brought in a new section 158AB. So you might be thinking, what is the difference between this 158AA and AB? Small differences. That is, see, in case of 158AA, I told you the concept is very simple. Already a case is pending in his case. In his case, you have to understand, already a case is pending in his case with the High Court or the Supreme Court, and the same case is actually another transaction of the same kind also happening again. So assessing officer will not pass directly the order. Instead he will wait till the High Court is passing the he will pass the order. Definitely assessing officer will pass the order, but then assessee will not go to appeal because already other cases pending in the High Court. So what assessing officer and assessee will agree that whatever High Court passing the order in the previous case, that same provision will apply to this case also. So this person will not go to appeal again. So what is the amendment? What is the new 158AB saying that? See, the case pending in High Court may not be you have to understand this. In case of 158AA, there was a wording that in his case, but in case of 158AB, that is not there. That means the case pending in High Court may be of his case or may be of any other person's case. So the same cases is pending in his case or any other person's case, the department can invoke this 158AB. So that means the scope of this section is wide than 158AA, because in 158AA the assessing officer could apply this only when the case is similar to the cases of the same person, but now it is widened that it can be applied for other person's case also. Okay, say for example, assessing officer taken up a case of Mr. A and is actually seen some cases, and assessing officer understood that the same case of Mr. B is pending with the High Court, and this case of Mr. B and this case of Mr. E is more or less similar. So the assessing officer and this Mr. A will be will enter into an agreement saying that okay, whatever High Court do providing a verdict, that will be applicable to this this case of A. So A shall not go for appeal again, because it will take time, right? So in order to avoid the repetitive appeal, they have brought in this 158 AB. Okay, you have to understand in his case or in the case of any other assessee, that is a major difference between 158 AA and AB. Okay, yes. So there is another things also they have brought in this 158 AB. You can just go through. Okay. Another thing, huge thing they have brought in is that dispute resolution committee. Earlier we had a settlement commission, right? Okay. Now we have that settlement commission has been taken away. Instead they have brought in a new thing called dispute resolution commission. Same concept only. So this dispute resolution committee, this is actually DRP the concept I've given here. Normally what happens is that assessing officer will pass the final order, then we can if we are not satisfied, we have to appeal it, right? But in case of dispute resolution commission, what is the option is that the assessing officer in respect of specified order, they will not pass the final order. They will not pass the final order. They will be passing a draft order. They will be passing a draft order. The draft order will be forwarded to the assessee. Assessee, instead of going to appeal, he can directly approach the DRC. Okay, so it's a settlement mechanism. It's a settlement mechanism. I've given here. Assessee filed the ITR. Okay, so the assessing officer proposes to make any variation on the income tax return he filed. So in respect of the specified order, you have to understand which are the specified order. Okay, in case of that specified order, the assessing officer will intimate the assessee. So if he's a eligible assessee, he may apply for the DRC, okay, with a fee of 1000. So who is eligible assessee I have given here. So yeah, so that's the concept of DRC and time limit of application and composition of DRC. Who else will be there in the DRC? Those things they have given. Power of DRC they have given. Okay, and time limit for passing the DRC. Okay, within a 1 month from the end of the month in which order from DRC is received. So they have to the assessing officer shall pass the order within 1 month. Okay, yes, that's it. So this is a new concept they brought in DRC, and they removed the settlement commission provision. Okay, in case of interest. 234A interest, it has to be computed on the assessed tax. It has to be computed on the tax, but then the tax does not include the additional tax under 140B. We have discussed updated return, right? So those additional tax does not include here. So on that interest not to be computed. Okay, yes. And the penalties and prosecution, we have a new penalty, that is 270K. That is, I told you that is under section 35. Those association, those universities, whatever laboratory, national laboratory, they have to submit a statement. They have to submit a statement regarding the donation receipt. If they so if they have not submitted the statement, the donor how it is going to affect the donor, he will not be eligible to claim the deduction under section 35. How it is affecting to that institution, they will have to pay a penalty of 10,000 to 1 lakh. And another amendment is that 270 to A or 2, there is a it was 100 per day penalty. Now they made for 500 per day. Okay. And in case of non-resident taxation, we have a few amendments to discuss also. These are all not latest amendment. Okay. What is the amendment? Let's see. There is 115 AC, that is a special provision for computing the tax income from bond or GDR, global deposit receipts, purchasing foreign currency, right? So eligible income means interest or bond or capital gain, whatever, tax rate is 10% on the above income. 10% on the above income. Then yeah, yes, that's it. So those are the major amendments that is actually you have to be thorough with the thorough with. But then there are other amendments also, but I personally consider not that important for exams. I have not discussed here, and also some amendments which are came not for this attempt but for the last attempt also very important. And in this video I focused only on the new latest amendments, right? So if any doubts you can have, you can ask in the comment section. Yes, yeah, that's it. So I hope this video is helpful, and if it's possible I will be coming with another video which will be discussing some like a revision, like, so in that video I am planning to discuss some more items, but I don't know whether time will permits. So if time permits, I'll be discussing, I'll be coming out with another video which will be more what we say detailed video. Okay, here in this video I'm focusing only on the just what we say familiarizing where all amendments has happened. Okay, that's more, but this was the only intention which I had, so I've done it actually correctly. So anyway, thank you very much, buddies. Okay, yeah.